And to that, I'm gonna add another one, and I'm gonna make that into a rainbow. Okay. This is interest rate risk premium. Those are the kinds of things that drive the yield curves. They're not easy to estimate and stuff, but it kind of explains why the yield curve in general is upward sloping, even the real part. And the shorter end tends to be governed a little bit more about uh, expected economic activity in the near future. So when we look at this graph, it automatically tells me what the market is concerned about. It doesn't mean it's going to happen that way, but given what we know right now, if on April 2nd, Trump finally says, I made my point, I said I did what I said I would do, we agreed on stuff, whether or not that's a good or bad deal for US, no tariff war, that thing is going to flatten out. Just now we have new information to act on. So always look at the yield curves, it tells you stories. They're not there just because they're fancy graphs. And do you really think that this affects only the bond markets? Why do you think we had all those crashes in the tech sector? Not crash, but significant declines. If the economy is going to be in a recession, who's going to be affected the most? Coca-Cola or Nvidia or Amazon? Obviously, the tech sector or Google or Microsoft. Are they going to be less likely to buy a new laptop with all sorts of AI stuff or not? We're not talking about spending $20. We're spending, maybe $1,500. Some people are going to postpone going to college. College students spend a lot of money and generate economic activity. So it affects everything. So bond market indicators are actually, very useful. You can even get certain summary measures. Let me show you this, and I'll send you guys home. This is always a very useful uh, website for data. Federal Reserve St. Louis has a database called FRED, which is short for Federal Reserve Economic Database. It contains a lot of historical information. One of those numbers is 5-year break-even inflation. Come on. And we have data on this since 2004. For example, what do you think had been going on around 2008-9? The so-called 5-year break-even inflation is -2%. The real yields were actually negative those days. What do you think was going on there? Yeah, it's the financial crash. There, the deep recession. If there's a deep recession, obviously inflation is not expected to be high. That immediately tells me what markets think going to happen. That doesn't mean it will, but that's market's perception. Similar stuff happened COVID times. It didn't go negative, but it went as low as 0.5%. And inflation was very low those days. 22, 334. This is 5-year average inflation. I'm not talking about 1 year. Right now, it was 2%, pretty much at the end of last year. It's pretty much higher. Market is concerned. That 0.5% is the big number. Fed's official target is 2% inflation. That's where they try to maintain on a longer term basis. If the 5-year expected inflation or break even inflation is 2.5, that means whatever that's going on, again, independent of your opinion on it, market is thinking that's going to create inflation. There's even you can do similar stuff with 10 years, but I tend to look at this 5 years, 5-year forward inflation. So let's just look at the last 1 year of this. This is what market thinks inflation is going to be for the 5-year period, 5 years from now. Essentially, it's a forward. You can get these from forward real. Again, used to be about 2. It's a little bit higher now. Those don't move as high as others. But always use these. Let's look at another one. BBB, option adjusted spreads. These are compensations for lending to corporations. BBB is the lowest credit rating you can get, and that is still considered an investment grade. For example, mutual funds can invest in them. Mid-February, it was 98 basis points. It went as high as 117. It's a little bit lower now. So market is concerned that whatever that's happening, credit quality may be affected. If you want to look at the effect on small business borrowing, small to medium, actually look at single B spreads. These are junk bonds, but most small to medium businesses, credit quality wise, are considered junk. That's not, I mean, it is a pejorative term. It's just low credit quality because of the nature of the business. It went from 260 about a month ago, 1%. Do you know how much different that 1% makes for businesses? It changes investment decisions. Margins are tight to begin with, even assuming availability of the funding. So market is thinking these are the things. Always look at these numbers. They're there for you. You can even find some esoteric stuff. For example, I used to look at, let me see. This is the share of net worth held by top 1% over the years. Back in 1990, top 1% of US households, these are based on surveys, held about a quarter of the net worth. This is after your obligations and stuff. Right now, that number is 31. If you looked at, there's even a number for the 0.1%. Those are even bigger. We can discuss why that is so, whether that's good, bad, or not, but use these sorts of information sources. It tells you stuff. All right. Let's stop here today. On Monday, we're going to have Jeopardy on. I don't remember which chapter I said, but those chapters on Wednesday, we're going to have it on chapter 9. All right. Then after that, we will go into our regularly scheduled programming. This is my kind of adjustment period.